Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. Today we're going to do a short segment on some of the issues and concerns that clients have brought to my attention over the past 28 years. As we engage clients on a regular basis, we do a complete audit of everything that they have in their portfolio. And we also try to use this platform as a tool to educate our clients, because at the end of the day, information without education always leads to failure. So this is a list of some of the things that are very critical, have been very critical for our clients over the years. And although I have probably north of 100 of them, I'm just going to cover several of them that I feel are quite important in maximizing your financial capabilities throughout your entire life. And this I call, I wish I would have known better. And we're going to start with the first one, which basically says that I wish, my clients would have invested less in qualified plans over their working years. And the reason for that is very simple. When you put money in a qualified plan, whether we're talking about an IRA, a 401k, or some kind of an employer benefit pension plan, yes, you are deferring the income while making the contributions into the plan. So if you're making $100,000 a year, and you put $10,000 into your 401k, you're only going to pay federal income taxes on $90,000. So you're deferring the $10,000 contribution that you make to the IRS or to your qualified plan. The issue with that is that when you're deferring the income while making contributions, you're also deferring the tax liability. The tax liability is never, ever going to go away. And the big questions for many of my clients is, where do they feel that taxes are going to be in the future? And normally when I ask that question, they can pick and choose one of three answers. Taxes are going to be a lot higher in the future, taxes are going to be lower in the future, or taxes are going to be where they're at today. Now, understanding the economics of this country and what is happening in the government, we do have $20 trillion dollars in debt, and that's counting every single day. I believe that the debt goes up by $2.4 billion daily, and that's not going to go away anytime soon. Now, all of these issues will apply to all of you, regardless of income and or asset size. The second, I wish somebody would have told me this a long time ago, has to deal with having a discussion with your CPA regarding provisional income planning. Provisional income planning is one of the most critical planning issues that you need to be able to discuss with your accountant or CPA. I would argue that almost 100% of all the clients that we engage here at Cambridge, first of all, have no clue as to what provisional income is and have no understanding of how it works. One of the main things with provisional income is that it determines, what percentage of your Social Security benefits will be taxed in retirement. Many of our clients feel that since Social Security was taxed, that was assessed to them at time while they were working. In other words, they were paying 7.65, of which 6.20% went to Social Security and 1.45 went to Medicare. They felt that they wouldn't have to pay federal income taxes on that money when it was distributed to them at retirement. And the answer is, it depends. Depending on your adjustable gross income at retirement, depending on the assets that are providing that income, a client may pay, and or a retiree may pay anywhere between zero. So if their threshold is below the number that is required, then they're not going to pay taxes on their Social Security benefits. If it's above a certain level, they're going to pay 50% on their Social Security benefit. And if they go above the maximum threshold, up to 85% of their Social Security benefits would be taxed. The other issue that is very critical is, as many clients are telling me, that they wish they would have invested heavily in Roth IRAs, Roth 401ks, and personal insurance and retirement plans. Under the IRS code, there are only 4 vehicles that are sold in the United States, or that are sold in the United States, that receive tax-free, federal income tax-free benefits under the IRS code. And those are the Roth IRAs, the Roth 401ks, municipal bonds, and personal insurance and retirement plans. Out of the 4, only 3 provide a total tax-free retirement benefit. Municipal bonds, although the income received from municipal bonds most of the time will be free from federal income taxes, that income gets added on to the provisional income calculation to determine whether the Social Security benefits will be taxed or not. If you own Roth IRAs, Roth 401ks, and personal insurance retirement plans, none of that income will be incorporated into the provisional income calculation. So the income from those vehicles are totally tax-free. Number 5, I wished I would have saved 20% of my annual net income over my working years. And this is a conversation that I have with my clients daily. For many years, I have been telling my clients that they need to save 15% of their net income, because we assign 3% to each and every one of those major eroding factors like taxation, inflation, market volatility, interest rate volatility, preponderance to spend, lawsuits, financial fees, and so forth. But because of the low interest rate environment that we have seen in this country for the past 10 years, it is critical that clients save 20% of their annual net income in some kind of an investment tool. The next one, which would be number 6, clients tell me that they wish they would have spent less on expensive car purchases and or car leases. I don't have the time to do this podcast today or to include this information, but I will do it in future podcasts. I use a calculator with my clients to determine the cost of and purchase of automobiles over a lifetime. Many clients are either leasing or buying automobiles every 3 to 4 years. And if you have a family where you need to purchase 2 cars or lease 2 cars, obviously the problem that gets compounded to a much, much higher level. What if you have to purchase cars for your kids while they're in school? All of those things are going to create a negative drag on your success in financial planning and or retirement planning. And the reason for that is that there's an enormous opportunity cost. Now, we all need to drive automobiles, but do I need to drive a Mercedes? Could I do something less? If I have to pay $800 of car leases or car payments, as many of my clients do, and some of them north of $1,000, well, can you accomplish the same thing by, paying $300 to $400? What would be the opportunity cost on taking that difference that you would have paid otherwise by being more frugal and investing that in an account? So those are some of the things that we're going to be discussing. Obviously, we're a spending society. The majority of Americans barely save 5% of their income, of their economic factors on a lifetime basis. So obviously, these are things that need to be addressed very critically from an investment standpoint. Another major issue that we get from our clients is once they understand the importance of having guaranteed life insurance policies as part of their portfolio, especially during their working years, is very critical to understand. One of the things that we try to educate our clients on is that no one ever dies at the right time. I have had clients that have died in their early 40s, early to mid 40s, some in their 50s, some in their 60s, some in their 80s. Just had a client a couple of months ago that was 94 years of age and passed away. So no one ever dies at the right time. And I can tell you a few things about life insurance. Number one, the benefit is never enough. And the reason why the benefit is never enough is because clients don't have an understanding of the role that life insurance plays in a portfolio for retirement purposes. So obviously many of my clients felt that they wish they would have known better, so they would have purchased more guaranteed life insurance contracts while they were young and healthier, as opposed to trying to do it once they hit their mid-60s from a business standpoint. Another major issue is that many of them tell me that they wished they would have been educated on the true economic value of a human life and how to protect the family unit from the loss of that human life. That's where life insurance comes into play. The majority of our competitors in the marketplace are selling life insurance or promoting life insurance programs for their clients based on what the clients and the surviving family or spouse may need in the future, on a needs-based. Well, the number one question is, how do you know what the needs of a client or a family is going to be 10, 15, 20, 30 years down the line? If we were to apply the same rules to everything that we own, most of us would be destitute and broke from a business standpoint. We at Cambridge promote a human economic value calculation. Every human life has an economic value. I have life insurance to protect my family and also to protect my assets as I start distribution and retirement. I want to make certain that my family is able to receive 100% of my economic value. The same thing as if you own a home and your home is valued at $300,000 or $500,000, are you going to insure your home for 50% of that value, or 25%, or 100% of that value? Most of us are going to insure our home, our cars, our jewelry, the stuff that we own at 100% of its value. So obviously, why wouldn't you apply the same things to either life insurance or disability? Disability insurance is another major issue. The ability that we all have to wake up in the morning and go run our businesses or go to work and earn a living is priceless. And how much would you pay if you have a machine sitting on your kitchen table that would throw out your income every single year? How much would you insure that machine for? Well, in a business sense, that machine is you. That machine is me. That machine is all of us. So we need to make certain that we insure that and protect that, because the probabilities of disability during working years are very, very high from that perspective. Another issue that we get from our clients regularly is that they wish they would have been more educated on how to add long-term care riders and disability riders to their life insurance contracts. For many years, we have done a tremendous amount of audits and appraisals on all insurance contracts whenever we engage a client for the first time. And then we continue to do these audits every 2 years with each and every one of our clients. Clients need to understand that becoming disabled not only provides a critical loss of income to the family unit as a whole, but if you have to continue to pay expenses, then that loss continues to increase. So when you add a disability premium waiver to a life insurance contract, as long as you've been disabled for at least 6 months, the insurance company now will come in and kick in the premium or the cost of insurance to continue to have that policy in force without having to have that insured person come out of pocket to pay that premium. When it comes to long-term care riders, long-term care is one of the major risks that the majority of my clients are facing today. And the reason for that is that we're living a lot longer. What used to kill us 30, 40 years ago is no longer killing us today, but by the same token, it may be leaving us disabled. And the problem with disability, it's either 100% or 0%. Either you just don't wake up and you go to sleep and you pass away and you die, and you never had any issues with long-term care, or you're going to have a long-term care scenario. Now, the question is, to what level? Are you going to need nursing care? Are you going to need hospice care? What kind of nursing facility are you going to utilize? And what is going to be the cost of that? I know in the state of Florida, the cost of a nursing home today in 2017 is $93,700 per year. Now, fast forward 10, 15, 20, 25 years down the line, and use an inflationary rate of anywhere from 6 to 8%, and see what that cost is going to be, and how will any family be able to pay for that. Well, long-term care riders provide the ability to add a critical illness rider to your life insurance contract. So when it comes to utilizing it for long-term care, as long as the client satisfies the 2 of the 6 ADLs, or activities of daily living, things that they cannot perform, then the policy will kick in, and the insured person can actually withdraw money from their death benefit while they're alive to pay long-term care expenses along those lines. Another big issue, which is now number 10, many of my clients tell me after we do tax planning for them, because we also provide tax planning services to our clients, that they wish they would have been a lot more educated on taxes, inflation, and market volatility during their working years. If you want to save money right off the bat, taxes is the most important. And by the way, taxes carry no risk. So you can actually put more money in your pocket without taking any additional risk whatsoever. Inflation plays a major role in retirement. And the reason for that is twofold. Number one, inflation is not tax deductible. So you cannot deduct inflation on your tax return. And on top of that, inflation can be aggravated depending on the income that you generate in retirement. So the higher your tax bracket, the higher income you're going to need in order to offset inflation. Market volatility plays another major role. The stock market goes up and down. I had clients in the late 90s that retired, and they had $1 million portfolio, and when the market went down, and the same thing happened in 2008 when the market went down, many of those clients went 2 to 3 years with negative market returns. But guess what? They were no longer employed, so they needed to dip into those investments, although they were losing money every single year, in order to maintain their standard of living. So that compounded the negative effect to their account value. And because of inflation and market volatility and taxation, Americans are finding themselves becoming Walmart greeters. Whenever you go into a Walmart, you'll see someone more than likely mid-70s to mid-80s greeting you as you walk in. Now, they don't want to be there. The idea is for you to stay active. And if you want to work, it should be because you want to, not because you have to. I would argue that many of those retirees are actually there because they have no choice and they need to generate additional income along those lines. Another big issue is that I hear all the time is that many clients are telling me, I wish someone would have told me that my Social Security benefits could have been taxed up to 85%, and we have already covered that. That their Medicare premium was going to be high in retirement. In 2017, the average husband and wife retiree will pay approximately $7,500 in Medicare premium, and that doesn't include the deductibles and other expenses that Medicare won't cover, that they have to be able to factor into their calculations. Nobody told them that they were probably going to run out of money before running out of life. And if getting old is bad, getting old and being broke is even worse. So it is very critical that clients do proper calculations, especially as they start to taking income distributions, because the rules of engagement change completely from the time that you go from accumulation to distribution. During accumulation rates, you're mostly concerned about trying to get a higher rate of return on your investment so you can accumulate assets. During your retirement years, you're going from accumulation to distribution. So here, you're mostly concerned about the distribution rate. Some of these clients tell me that they wish somebody would have told them that their tax liability in retirement was going to be as high, if not higher, than prior to retirement. This is something that many clients don't understand. They were putting monies away in their qualified plans while they were working. And they were putting monies away in their IRAs and 401ks at a time where they had a lot of deductions. Why? Because they had a home, they had a mortgage, they were taking mortgage deductions. They had kids still at home, they have 2, 3 children, so they were taking deductions and exemptions for those children. And obviously they were also maximizing their standard deduction, or they were itemizing the deduction. The big question is, and this is because of lack of education, why would they want to compound that issue by continuing to fund their retirement plans on a tax-preferred basis or on a pre-tax basis? Well, when they hit retirement, all of a sudden, a lot of those deductions go away. Now, some will stay, like your standard deduction, or if you have more than that, you can itemize your deductions on your tax returns. But some of the credits and the exemptions go away. Most Americans want to have their home paid off by the time they retire, so obviously they're not going to have any mortgage interest deduction. Their kids are hopefully going to be out of the house, so they're not going to be able to take the credit and exemptions with that. So if you have a husband and wife that are now in retirement, they're both getting Social Security, they're both getting income out of their qualified plans, IRAs or 401ks. Some of them may still be working on a part-time basis. So all that income is coming in, and there's very little to offset. So even if taxes were not to go up in the United States, the fact that you're losing those deductions may actually increase, and in many times will increase, your tax liability in retirement. Yes, I understand that the Trump administration is now bringing forth some tax benefits to Americans. The challenge is that the last I heard, the average American family earning $100,000 with 2 children in a household will save approximately $1,000 in taxes a year. Okay, it's better than nothing, but it's not close to having a true tax performing program. And even if they're able to do it, it's going to have to be done under budget reconciliation, which is only good for 10 years. So in year 11, someone else can be in power, and if they decide to get rid of that law and increase taxes immediately, then they could. And all of a sudden, none of us have any control of how that would work and the impact that would have on our financial life. Another big issue, once we cover all the issues of taxation with our clients, is that they tell us they wish that their previous advisor would have told them that they could have converted a portion of their qualified plan assets from assets that are forever taxed, those are 401ks and IRAs, to assets that are never taxed on an annual basis, and those would be the conversion to Roth IRAs and making more contributions to Roth 401ks as opposed to traditional 401ks, and most important, creating a personal insurance and retirement program that would allow clients to maximize their contributions to these plans without having to worry about paying taxes on those assets in the future. Another challenging issue, and this would be number 12, we just have a few more to go, is that a number of my clients would tell me that they wish someone would have told them the importance of having proper wills and trust in place for the execution and transfer of assets to the next generation. A trust is nothing more than a holding tank where everything that you own will be in that tank, and it will be set up through wills and obviously the trust documents in an orderly fashion. You want to make certain that when you pass away, that your assets will go to the people that you intended them to. Obviously, your surviving spouse, your children, charities of your choice. You want the least amount of those assets to go to the government, because at the end of the day, when you pass away, your assets are going to go to either one of three organizations or all three combined. So it's either going to go to your family, it's going to go to a favorite charity of your choice, or it's going to go to the government. You want to make certain that you do it in that order. You want the majority to go to your family, the next majority to go to a charity of your choice, and the least amount of money possible to the U.S. government, because you have already given them more than enough. And that's just my personal opinion on that matter. Another big issue is that many of my clients, especially those that are currently in retirement, they tell me that they wish they would have more guaranteed income at this point in time in their lives. If you're putting money away for retirement and you get to age 65 or age 60 or age 70, whenever it is that you decide to pull the trigger on the retirement item, if you don't know what your guaranteed income will be in retirement, then I would argue you don't have a retirement plan. Now, you can do it in many different ways. I have clients of mine that have come in and we've done all their planning. We have put all the assets on a spreadsheet. We have done all the calculations, and then we have identified the dollars that they need to meet their fixed expenses for life. And obviously then we're going to use a buffer. We're going to add an inflationary rate, and then we're going to purchase products that will be earmarked just to guarantee those fixed expenses for the rest of their lives. And then the rest of the money can be utilized for other investment purposes or business opportunities as such. Now, other clients are a little bit more conservative. They want to take the majority of their income in retirement and making it guaranteed not only for themselves, but also for the surviving spouse. So again, it all depends on how it is that the clients feel about their income, what kind of assets they own, where are those assets located, what kind of assets and the income that those assets are providing. So obviously we do a lot of calculations along those lines from a business standpoint as well. We only have 3 more to go. So the next one, which would be number 14, many clients tell me that they wish they didn't refinance their property at a lower interest rate when they did so. And one of the things that we try to do with our clients is many of our clients make a lot of money. They just don't understand how money works. And let me give you an example. Let's say that you have a 30-year mortgage on your property. You're now in year 8. By the way, as a point of reference, normally the first 8 to 10 years in a 30-year mortgage, the majority of the payments that you're making are going toward interest. So if you have a 30-year mortgage and you're paying 5% interest on that mortgage, and all of a sudden the bank comes back to you and says, Mr. and Mrs. Jones, we have a great offer for you. You could refinance your home, and instead of you having to pay 5%, you'll pay 4%. You have no idea how many calls I get on a weekly basis by clients asking me to figure out whether it makes sense for them to refinance or not. Now, the good thing is that they're reaching out to me. They're reaching out to a professional that understands accounting, that understands financial planning and financial calculations, so I'm able to do a good job for them along those lines. Many of them, on the other hand, by the time I get to visit with them, they have already done their refi. And many of them have done it multiple times, 2, 3, 4. I have a client that I engaged about 7 years ago. At that point in time, he had refinanced his home 5 times in a period of 7 years. Here's the issue to consider. Most of us in the marketplace pay attention to the annual percentage rate. We don't pay attention to the volume of interest, and that's the one that the banking industry pays attention to, and that's why they make tremendous amount of money off all of us. And here's the situation. If you're a good paying customer and you're paying your mortgage on an ongoing basis at 5% to the bank, because that was a lending price that they put when they gave you that loan originally, and you're a good customer, you never miss a payment, you're always on time, and now you're in your 8th year, why would it make sense for a bank to come back to you and ask you to refinance and reduce, and they're willing to reduce the interest rate from 5% to 4%? Well, if you're using common sense, you would say, well, the bank is making less. Now they're making 4 on their money instead of 5. Why would they do that? Well, they do that for one simple reason, and that's a reason that we as consumers don't pay attention to. The reason is that by refinancing, you're starting the clock all over again. So now for the next 8 to 10 years, the vast majority of the payments that you will be making on that mortgage would be interest payments, as opposed to had you stayed with your mortgage, now in year 8 to 10 you would start dipping more and more into principal, and they want to start that clock every single time for as long as they possibly could, because they live off the interest payments that you are making, and they're able to leverage that 10, 15, 20, 30 times over from a business and financial situation. Another big issue, and by the way, all of these topics, if you're interested, feel free to reach out and we'll go into a lot of details. I'm just giving you an overview of these things. But another major issue that I get from clients on a regular basis is that they tell me they wish they would have been educated on how to purchase real estate. Now, one of the good things that we do here at Cambridge is we do real estate calculations for our clients, because we do have a number of clients that are in the real estate business. And when they call us, they trust us and they give us the information that we ask. And this I will do another podcast on, but here we go and we do calculations on the income and expenses on the properties the property that they want to purchase. We do net operating income calculations. We do cash flow calculations. We do cash on cash calculations. And we do capitalization rate, or cap rate as is better known in the real estate industry, calculations in order to identify whether the purchase of that property, A, is going to meet the required cap rate that the client is looking for. In other words, what rate of return would they want to have on that piece of property? And B, if it makes sense to make that investment from a business perspective. Now, obviously, we could go quite some time along those lines. And the one major thing that we do compared to our competitors out there in the marketplace is that we do a lot of work in economic planning. The majority of financial institutions do not teach their advisors on economic models or economic planning. Primarily, they're teaching them on the products and services that each institution want their advisors to sell. Now, we are at Cambridge, we're independent advisors, so we're not married to any one company per se. We're primarily married to our clients. And one of the things that we pay attention to is that when it comes to financial services and planning, there are many, many methods out there that are available. And what we always say is that, methods are many and principles are few. Now, methods are always changing, yet principles never do. So the principles of economics that we follow with each and every one of our clients are principles that have been around for centuries and for many, many decades and many, many years. And we don't change those principles because they're applicable to just about every financial situation that you can encounter. And the final one is the one that I feel blessed and feel the most excited about, is that, once we engage our clients, many of them, by the way, have talked and have done business with many other advisors throughout their years because they have been very successful in what they have done. But the one thing that they tell me on a regular basis is they wish that they would have started working with Bert Salazar a lot sooner in their financial endeavors. And that gives me a tremendous sense of pride because they understand that the type of economic planning and the revolutionary financial process that we do through an evolutionary exercise is one that will definitely provide success for them as they approach their financial endeavors, as I just stated, and or their retirement life. Last but not least, and this is something that we feel very strongly about, is that the number one job for us here at Cambridge, and for me here at Cambridge, is to change the way that people see things, that my clients see things. Because when people change the way they see things, the things that they see change. I truly appreciate your being with us today and learning more about some of the issues and concerns that we have encountered with clients for many, many years. So stay tuned for more financial podcasts through the Cambridge Financial Literacy Podcast channel. Have a wonderful day and enjoy yourselves.